I don't mind the rain, but I don't know about you guys. This year in Sydney has been so wet. It's sent me absolutely bananas. We've had kids locked up, going absolutely feral. I'm asking myself, how many times can we play another board game? Is school sport going to be cancelled again this weekend? So much so that I've been watching the rain radar more than I've been watching the ASX. And then I had an epiphany recently. It had been raining for about 5 days straight, and I thought to myself, well, I can stay locked inside with these feral kids, unhappy wife, an energetic dog, or we can just brave it and get out there, like this guy. And the reason I say this is because it's got relevance to today. No one likes recessions, no one likes interest rates going up, and no one likes share market volatility and share markets falling. But at some point, we've got to go out into the rain. And so what I wanted to do today was share with you some insights. Firstly, I'll give you an overview of how we see the macro, and that's pretty quick. You'll hear a bit more about that today. Secondly, share with you our philosophy of investing in both value and growth opportunities and a framework for thinking about that. And then finally, share with you 2 new ideas that have been put in the portfolio in the last few months alone. I want to leave you today with the idea that investing in both value and growth opportunities can lead to more stable alpha, and that's the strategy the Firetrail High Conviction Fund uses. So let's get into it. I don't know where to stand here. I'll stand over here for now. The macro is pretty messy because we've got all these energy costs going up. We've all heard about labour inflation and everything. For us at Firetrail, we think energy costs are the biggest concern to economic growth, and none more so than in Europe. This is European natural gas prices. They've been very volatile, but they're up at around 90. I think today they're about 70, but it's gone up a lot. I mean, to put those numbers in context, that number there is around 80. In the US, gas prices today are $10. In Australia, long-term contracts can be written for around 12. So you can see Europe has got a major headwind in their competitiveness, and we're seeing a lot of industrials shutting down. So energy costs are high, no one's happy. Right? I don't know if this is just a permanent state of being, but we're more unhappy than usual. And you can see here, this is the Westpac Consumer Confidence Index. It's almost at the lows of COVID. Now, I don't know if you remember COVID that well. I remember it pretty well, but being locked inside, that's how people, confidence in the market today, that's sort of the lows we're at now. So people are very unhappy. And then finally, the market's nervous. So the market today, the ASX 200 is trading on just under 15 times PE. It was trading around 17 times before that, so the market's come down a little bit. But look what the market's willing to pay for Woolworths. 26, 27 times PE. Because they're so nervous, they're gravitating towards defensives. So I think it's time to dig deep to find winners. And I'll talk to you about how I think you can do that. The Firetrail High Conviction Fund uses a philosophy that every company has a price. All stocks can outperform in the right conditions, and we've seen that proven over time. Instead of just saying we'll just buy value or just buy growth, we look at everything. And the reason that's important is because value and growth factors can be very cyclical over time. To give you an idea, the value factor underperformed from 2014 for 8 straight years. So if all you did was buy value stocks, you'd have to be very good to deliver good returns through that period. Equally with growth, they're great companies, everyone loves them, gee, that's a quality company. But if you bought a lot of growth stocks in the year 2000, you would have underperformed for 7 straight years. So we're not saying you should buy one or the other. In fact, we're saying you should consider both opportunities. How do you do that? Well, the one thing we like to do is wait for opportunities when the market gets negative. There may be a short-term headwind, especially when things are cyclically down and people start saying it's structural. These are all terrific opportunities and a great time to make money. And so what I wanted to do now was share with you some of these opportunities, one in growth and one in value. Now, what do these have in common? I did this to my son the other day. He's 8, and he said they're both found on the farm, which is a correct answer, but not the answer I was looking for. The duck and the cow. We'll talk about why this is the case, but the conclusion is that we've bought a position in Origin Energy, and we see 40% upside from today's share price, and I'll share with you why, and also why the ducks and cows have got anything to do with anything. We're going to start with the duck curve. Now, this is quite a technical chart, but it's also a pretty simple chart, and up the back, if you can't see it, I'll narrate it for you, so don't get too down. Renewables are upending energy markets globally. Solar and wind is going in at an accelerating rate. But we know solar, the best solar panel in the world, will operate about 22% of the time. In Australia, the average is 14%. Wind, a great wind farm will operate 35% of the time. So it's very up and down. Solar in particular has become very, very popular in Australia. 30% of households have solar on their roofs, and we are the leading country globally for solar penetration. But what it's meant is it's really changing the way markets work. So what you can see here, this is electricity demand from the grid. And what you can see is this is 12 a.m. and far on the right it's 9 p.m. And what you see over time is we're pretty flat, and then everyone wakes up in the morning and it starts going up. People turn on the kettles, the toasters, the TVs. And if we look at 2012, this is this top line here, you can see we all wake up, and then we sort of go to work, and then we turn up at home and we put on the air conditioner or the heater. We start using a lot of electricity. So that's pretty normal. But look at this duck curve. This looks like a duck, doesn't it? In 2020, what's happened is we're still using the same amount of electricity, but the solar turns on in that middle period. And this is really interesting because it's reducing demand during the day very materially. It's down about 40%, 50%, or almost 50%. Prices are going negative during the day now. So if you're a coal-fired power station with no flexibility, you have to run all day long. You will actually pay for your coal, you will burn the coal, and then you will have to pay money to the grid to sell that coal. Negative prices. It sounds perverse, but that is how the market's working at the moment. We think Origin has the assets to win in the future. What kind of assets do you want to win? Well, you want to have some solar and wind because they are low cost. Secondly, you want gas-fired power stations. Origin has gas-fired power stations in every major market in Australia. This is very important because gas-fired power stations can turn on in a matter of minutes. It's very, very hard to build a new gas-fired power station today, and so Origin's got these sunk assets, very flexible, and it's going to be very advantageous in the future. And they're also working extensively on demand management. My belief is that demand management is going to be one of the great ways we can save energy over time in a smart way. And give you an example of what they're working on is if you've got an electric vehicle, and we're going to have them more into the future, you can have smarts in the home that says, well, when the solar's on, charge your EV. When it's not, when the prices are high, you could even potentially drain that battery. So there's demand management being worked on too. But I would say those gas-fired power stations are going to be very valuable. Overall, Origin is very, very well placed for the future we see in electricity markets. That's the duck. Now let's get to the cow. It's a cash cow. It's APLNG. So this is a Queensland gas project, and they sell the gas to Asia, predominantly China. Now you saw from the first chart, gas is very much in demand because it's very flexible. And so as we get more renewables, people are going to want more gas to hit the highs and lows. It's a tier 1 asset. It's very long life and very low cost. And when we think tier 1 assets, I'm sure many of you think of BHP and Rio. You know, they'll make money through almost all markets. APLNG in the gas markets works like that too. Its long life, 2038 is the current life today, and they're adding all the time to new reserves. And the second thing is it's low cost. So it makes gas for about $3 to $4 a gigajoule. Now put that in context, in Australia I talked about 12. In Europe at the moment we're talking in the 80s and 90s. So this is a really tier 1 asset. And cash is king. These are 19, 20, 21 and FY22 dividends that have been received from APLNG to Origin. And you can see in FY22 they received more than $1.6 billion from APLNG. Now to put that in context, that's 16% of Origin's market cap. This is a huge cash cow. What it's allowed Origin to do over time is de-gear, and now they're doing buybacks. So especially for this kind of market, we think Origin is really a great place to be because they've got flexible assets to win in the future, and they've got that cash cow for today. What I wanted to do now is touch on the ultimate defensive. Now we saw from Woolies, everyone loves defensive stocks. CSL, we believe, is the ultimate defensive. And it's the ultimate defensive for a few reasons. The first one is they operate in a growth market. So what they do is they collect blood, turn it into plasma, and then sell that into a medical setting to help people who have poor immune systems, in short. What's happened over time is that market's generally grown at 8 to 10% in terms of their top line. So CSL is a proven growth company. And the key way they make money is through blood collections. So US is one of the only markets, there's around 5 globally, that allow pay for donation. So in Australia, we give blood, but it's voluntary. In the US, you actually pay for donations. And it's usually between $40 to about $120 for a donation. But as you can imagine, these collections dived massively through COVID. In fact, at the bottom of COVID, those collections, those blood and plasma collections, were down 40 to 50%. It was a major headwind to their business. What we've seen, though, is it's rebounded. But what's been really interesting is why that fell. Now, the obvious reason is people were locked down. They didn't feel confident to go and give blood, and that's one reason. But we think an even bigger reason is because there was so much stimulus in the economy. Low-income earners felt very, very rich. They had a lot of fiscal stimulus thrown at them, and they didn't need this supplemental income, which is really what it is for many people in the US. That's what makes it defensive. The worse it gets, the better it gets for CSL, and plasma collection is bouncing back. But the great thing about CSL is they've continued to invest through this COVID headwind. They've continued to roll out centres. You can see today they're at 307. This really is, I guess, the lifeblood. That's not a pun, it's not even funny, but it is the lifeblood of CSL's growth. They've been rolling out collection centres over time, and they've continued to do that through COVID. But the really exciting thing, and probably the most boring picture you'll see today, is this machine here. It looks like a photocopier down the back. I mean, it may as well be. But it's called the Rika machine, and it's made by a company called Terumo. This is really important. CSL is rolling out these machines into their collection centres. The first one was rolled out on the 8th of August this year. What this machine does is 2 things. The first thing it does is when you give blood, it typically takes 50 minutes. That's going to reduce to 35 minutes with the new machine. That effectively increases the collection capacity in each centre. The second thing it does, it allows you to take out more blood per customer. So when you go into a collection centre in the US today, you get on the scales, and based on your weight, that determines how much blood can be taken out. With the new machines, they operate a lot smarter. It uses BMI and other technology, and you'll be able to take out 13% more blood per person. The overall impact of that is that CSL's cost of goods sold is going to fall 16% over the next 3 to 4 years. And in a world of inflation, CSL have actually got a backdrop of falling costs. And this makes it a very attractive company, and it's an opportunity to buy it at a great time. The reason for that is it's cheap versus other defensive alternatives. Where would you want to allocate your capital to? On the vertical axis here, this is 2009 earnings growth. You can see Woolworths here. People are on FY24, 24 times PE, and Woolworths has grown its earnings at 1.7% since 2009. Everyone's talking about today, oh, it's great, everyone loves supermarkets, this is amazing. The fact is, since 2009, it's grown its earnings at 1.7% per annum. Consider CSL. You do have to pay a premium, a few extra PE points, but it's a proven grower. You know, that 10 to 12% earnings growth has been stable over time, and we think it's going to accelerate through this period. It's a rare opportunity to own a great company, importantly, at a great price. So there you have it. Let me put it together for you. Conditions aren't great out there, but at some point we've all got to go out in the rain, and there are definitely opportunities emerging. Secondly, there are significant opportunities, and I'm strongly of the view that you need to be invested in both value and growth stocks to avoid those big cycles over time. And then finally, there is material upside in Origin, the duck curve and the cash cow, and then also CSL, which is going to emerge from COVID stronger than ever. I know there are many people in the room who do invest with us, and I really appreciate that support. If you don't invest, we would urge you to consider the Firetrail High Conviction Fund, where we implement a strategy that invests in both value and growth in a concentrated fashion. Thank you.
Thanks, mate. Wow, what an opening act.